Good morning, everybody. Welcome to today's edition of the Daily Market Commentary. I'm Chuck Fulkerson. Hope you guys are all having an amazing day. It is the 19th of January. We're going to do our daily market commentary like we do each and every day, although normally we do it live. For some reason this morning when I went to go live, we had technical difficulties and I wasn't able to get my stream set up. So we are doing this on a recorded version, so I apologize for those of you that were joined with us live. And I was not able to complete that, but hopefully it's the same information. So let's go ahead and get rolling. As always, if you have any questions, please make sure to shoot us an email, chuck.fulkerson@tradersarmy.com for any questions that you might have. All right, let's go ahead and get rolling. I'm going to fly through these markets fairly quickly today. ES, we're taking a look at. We have a little bit of a wick over wick supply level here up above us. That's a fairly clean level. Now on our 4-hour chart, we're up about 27 points this morning. So this wick over wick supply that we are sitting in front of is not going to be one that I'm going to want to use. And the reason for that is what we call the kiss of death, right? We've got basing here before the level within a, kind of our risk on this trade at the tightest would be here. And so our basing would be about a 1-to-1 reward to risk, which does not make for a quality trade idea. So we're not going to use this level. However, it could set up for what we call that little Globex trap. And if we do pull back a little bit, I would say that down here is a potentially clean level. Now, this was formed during yesterday's, at the very end of yesterday's session from the Globex perspective. So the volume there is just not anything to lean on. But it could be a reversal point. Looking at the Nasdaq, now the Nasdaq, we did come back up to that little wick over wick area that we had in the S&P, and it's just gone nowhere. So we hit it there and stalled, which if you took a trade, 6 candles, I'd tell you that you should probably consider getting out of the trade. And then the same level here as exists in the S&P level before the origin of this move higher. Now we've got a couple of levels down here that we had talked about. Unfortunately, price didn't quite make it back down to this region. And so we need to switch that to a confirmation entry on this level over here to the left. Looking quickly at the Russell, we did have a level that was super close to getting us an entry on Friday. Did not give us the entry, and so this is now a confirmation trade with looking for price to return back into this region. We can also see that there's potential for a breakout above the high, and so price can continue to run. In all of these markets, we are in an overall upward trend. Our trend has definitely shown signs of weakness. No ifs, ands, or buts about it. I put a tweet out about this yesterday, but if you just look at the daily chart on the SPX, I just used the SPX because it was easy to see. When you throw your MACD in there, you can see very clearly that we have divergence in our momentum indicator as well as our price. And so, the other word for this momentum indicator is an accelerometer. Just think of it as accelerometer. Our acceleration to the upside is slowing. And so just kind of keep that in mind as well, that we could see price slow down and roll over a bit. Now, once again, that's all relative because that accelerometer includes a lot of frankly, what were nearly parabolic price moves before it. But it is something to consider and just be aware of it, especially coming in here to the end of January. Historically, the markets move up in January, and so we oftentimes, especially the last couple of years, have had pullbacks in February. Looking over to energies and metals, crude oil is just sitting between areas of demand and supply with not a whole lot to go on right there. We've got a little rally, a little drop-based drop right below a pivot low up above us. That based upon where we see our pivots, that would be a confirmation entry. Although we do have a lower swing low, we don't technically have a lower swing high as of yet. And so really any of these positions are actually better as confirmation trades right now, because if we get back up to here, we're still in an uptrend. If we get down to here, then we're in a downtrend. So I would want both of those to be confirmation entries since we are kind of at an inflection point in our 4-hour trend. Remember, if we get down to here, that means we've got a lower swing low and a lower swing high. If we get back up to here, that means we have a lower swing low but no lower swing high. In gold, we see that gold has a little bit of a resistance area up above us at 1864. With that gold resistance area, the better trade was this area right here off this little wick over wick, where we've actually started to get a little bit of a move down from that zone. So, you know, with that area already being utilized, there's not a whole lot in here. And so what I would say is don't force the trade, right? Don't force the trade. And we talked about this last week, that the markets could be doing a little bit of sideways price action in anticipation of the inauguration and what may happen with the inauguration. Not that we think anything major is going to happen. I don't see that as being an issue. But if there's a sentiment of, you know, just sitting on the sidelines for a little bit, let's just see if that's kind of what's going on. Same thing with our commodity plays. We got some breakout trades above us in our commodity plays. They all have a little breakout area here that could become viable above soy, above the high here, provided we get basing, right? One touch, two touch, I need my third touch for basing. Corn, one touch, two touch, I need my third touch for basing. Wheat as well, one touch, two touch, I need my third touch for basing. We did not make it all the way into our confirmation demand area. And so that one, although it's a very clean wick over wick, we didn't quite make it in, and so that level needs to go away. Looking over at our bonds and currencies, if I take a look here at our ZN, which is our 30-year or 10-year note, our 10-year note, we are coming up into a potential wick over wick area up here. Very clean level. We came close to it without getting filled. Our 4-hour chart would tell us that we should probably make that a confirmation trade, especially since we came so close to it without getting filled. But it is still valid. We've not changed the validity of the trade, just the probability of the trade. The other thing I'll say though is that if we break down below here, you may get a move down below this region for price to kind of come down from here. Next one I would take a look at would be, are we going to see a breakdown on this one? This one's not quite as clean on the 30-year. The 10-year is significantly cleaner. Looking at the euro, so on our euro position, we had taken a look at this area here for a supply zone, but we didn't come up into it until in the Globex session. Really not a great setup for that anyway, especially with the basing in front of the level. And so this hidden pivot that we have hidden out here is still, I think, your best bet, although we're in a pretty strong downtrend. Keep an eye on a 4-hour candle-to-candle setup, because this is a bear rally short setup, right? Bearish move down, rally back up. Could we get a turn in the other direction? And that would be the next strongest move down. Looking at Canadian dollar, so the Canadian dollar, we've come back up to this area of supply. That supply is certainly going to be no good since we're basing in front of the level. Kiss of death would come into play there. And I think, you know, we've got a little bit of supply here, but I don't like it as much as I like the area up here. The area up here is a bit cleaner. Although this is a pretty good time of day, it's a bit wicky all the way through there. So really nothing to add here on the Canadian dollar today outside of the levels that already exist. And then we start to take a look at the New Zealand dollar. So in the New Zealand dollar, we've got a couple of lines here. Let me go ahead and remove these real quick. These were some price targets from a lower demand area, which price hit that demand area and then kind of went sideways. So in looking at this on our 4-hour, our overall trend direction is definitely coming down. And so we would be better off looking at shorts. And even if we rally back all the way up to here, we're still going to be in that bearish price direction up into that zone. Great British Pound, we've got a little bit of resistance up above us here for a potential breakout. And then there is some 15-minute demand down below. If we look at this here, we'll be able to see it a bit more clearly. This wick area right in here, and all those upper wicks have been removed from the actual zone itself. In the Japanese yen, we got a supply area right there where price could make it up into that zone. I will say that I don't love this area. I liked it a lot more before we have been very range bound inside of it. The breakdown, I think, is still the better way to go. You could have a little reversal right in here, as we do have a very clean wick over wick that was formed. So that does also come into play. It was formed basically right at the Japanese market open. So it's for that market's opening trade, which is not as bad of a setup. And then the Australian dollar, a lot like the New Zealand dollar, although very wide range that we're in, overall, our 4-hour trend is coming down. So I'm going to leave the New Zealand dollar and the Canadian dollar both kind of alone today. So once again, I apologize for the live feed not working well this morning. We will post this archive as soon as we can. So hopefully you can catch that one at the very least. If you guys have any questions, please send us an email, support@tradersarmy.com. Till tomorrow, everybody. See ya.